In 2008, the market fell 57%. 8 million Americans lost their jobs, but some families came through without losing the house, without selling at the bottom, without running out of cash. They won because they made these 7 specific moves at the right time. So watch this if you're worried about 2008 because it may repeat.
Some people came through 2008 without losing the house, without selling their retirement at the bottom. They weren't smarter. They made 7 specific moves before the crash arrived, and those moves were available to anyone who was paying attention. Here's what those moves were, and here's what the signals look like right now. The crash didn't come without warning. Home prices peaked in July 2006. Subprime delinquency started rising mid-2006. The ABX index tracking mortgage-backed securities started falling in January 2007. Bear Stearns' 2 subprime hedge funds failed in June 2007. Every signal was visible. The families who acted in 2006 and 2007 didn't know Lehman was coming. They saw the direction of the signals and moved before the window closed. 8.7 million Americans lost jobs between December 2007 and June 2009. Unemployment climbed from 4.4% to 10% over 27 months. The S&P fell 56.8% from peak to trough. Most households came through that period worse than they went in. The ones who didn't had made these 7 moves. None of them required predicting the exact date. They only required seeing the pressure building and acting while there was still time. Move 1, pay down high-interest debt before credit freezes. After Lehman Brothers collapsed in September 2008, banks cut credit lines immediately. American Express reduced credit limits for thousands of customers in early 2009. Chase cut home equity lines across millions of accounts with little notice. Families carrying high balances when those lines were cut were trapped. The average credit card rate in 2008 was 13.9%. Every dollar paid down in 2007 was a dollar not compounding at 14% through 2 years of crisis. The families who went into September 2008 with clean balances had options. The families who didn't had a problem that got worse every month. Move 2, build 6 months of liquid cash before the crunch arrives. Unemployment climbed for 27 consecutive months. The families without cash reserves who lost jobs were forced to sell into a market that was down 57% at the trough. They crystallized a loss they never recovered from. The families with 6 months of cash in FDIC-insured accounts absorbed the job loss without touching their investments. They held through the bottom. They participated in the recovery. The difference between those 2 outcomes wasn't income level. It was liquidity before the pressure arrived. Move 3, lock in a fixed-rate mortgage before the credit freeze. In 2006 and 2007, adjustable rate mortgages made up roughly 28% of all originations. 2.6 million ARM holders faced payment resets between 2007 and 2009. Monthly payments jumped by hundreds of dollars when rates reset on homes that were simultaneously losing value. The families who'd locked into 30-year fixed rates before the freeze kept predictable payments throughout. The refinancing window slammed shut in late 2008. Lending standards tightened. Home values had fallen. The families who hadn't locked in found the exit closed. The families who had kept control of their single largest monthly expense through the entire crisis. Move 4. Don't sell long-term investments when the market breaks. The Vanguard 500 Index Fund closed at $140 in October 2007. It closed at $61 in March 2009. It closed at $146 in March 2013. The families who held recovered fully in 49 months. The families who sold at 61 locked in the loss and didn't participate in the recovery. Dalbar's annual study shows individual investors underperform market indexes by 3 to 4% annually, primarily from panic selling during downturns. The move isn't to buy more at the bottom. The move is to not sell on the way down. That one decision separated 2 very different outcomes for millions of households. Move 5. Know your FDIC limits before a bank fails. IndyMac Bank failed July 11, 2008. Washington Mutual failed September 25, 2008. $307 billion in assets. The largest bank failure in American history. Depositors with accounts above the insured limit lost portions of their savings. The insured limit is $250,000 per depositor, per institution, per account category. Families who understood that and distributed their deposits accordingly recovered 100 cents on the dollar. Families who didn't found out the hard way that the guarantee they assumed had terms they'd never read. The information was always available. Most people never looked at it until it mattered.
Hey everyone, sorry to cut in, but I want to make this quick. Look, the families who made it through 2008 had a framework that helped them avoid panic. The real estate crash bundle that I put together is built to help you think that way right now. How to spot the pressure, understand what stage you're in, and make better decisions before the market forces your hand. I'm going to throw the link down below, and now let's get back to the video.
Move 6. Diversify your income before your single employer disappears. Construction lost 24% of its workforce. Financial services lost 7.5%. Manufacturing down 17%. Retail down 9%. The families with a second income stream, a rental property, a side business, contract work, a spouse's independent income, had a buffer when primary employment disappeared. The Bureau of Labor Statistics documented that households with multiple income earners recovered from job loss 42% faster than single income households. The single job, single company, single industry household had no cushion when that one thing went wrong. The families who diversified their income before the crisis didn't need the cushion to be large. They just needed it to exist. Move 7. Build a household inventory buffer before price volatility hits. Grocery prices rose 3.7% in 2008. Gas peaked at $4.11 per gallon in July 2008, a record at the time. Lower income households were disproportionately hurt by those price spikes because they had no buffer. Families who'd built modest stockpiles of staples, canned goods, dry goods, cleaning supplies, medications in 2006 and 2007, when prices were lower, paid 2006 prices for those goods through the crisis. This isn't hoarding, it's household inventory management. Every major cost of living study from 2008 confirms the same finding. The households without any inventory buffer absorbed the full force of the price spikes. The households with even a modest one didn't. Those are the 7 moves. None of them required knowing the date. None of them required being wealthy. All of them required seeing the direction of the signals before the majority of the market acknowledged them. Here's where the signals are right now. Consumer confidence at the 2nd percentile of all recorded history. Auto loan delinquencies at the highest level since 2010, credit card delinquencies matching 2008 levels, foreclosures rising for 12 consecutive months. Moody's recession probability at 49%. These aren't the same numbers as 2008. They're the same pattern, the same sequence, the same direction. The families who made these moves in 2006 didn't know that Lehman would fail in September 2008. They made the moves because the data told them pressure was building. The data right now is telling the same story. Move 1 is available right now. Pay down the high interest balance before credit markets tighten and your limit gets cut without notice. Move 2 is available right now. Build the 6 months of liquid cash before the job market softens further and you're selling investments into a down market to cover expenses. Move 3 is available right now. If you're carrying an adjustable rate product in an environment where lending standards are tightening and home values are under pressure, the refinancing window you're assuming will be there may not stay open. Move 4 is already underway for some households, and the data says it's the wrong move. Selling into pressure crystallizes a loss. Holding through it preserves the recovery. The families who sold in March 2009 didn't recover. The families who held recovered in 49 months. Move 5 takes 1 hour. Map your accounts. Know which categories are separately insured. Know your actual covered exposure at every institution where you hold deposits. 1 hour of preparation before the next bank failure announcement on a Friday afternoon. Move 6 is the one with the longest lead time. A rental property, a side business, a developed skill that generates contract income, those take months to build. The families who had them in 2008 built them before the crisis, not because they saw it coming, because they understood the risk of having only one income source. Move 7 is this week's grocery run. Modest, not a bunker. The difference between absorbing a 10% price spike on goods you already own versus absorbing it at the moment prices are highest. Everything in this video is drawn from documented history, what the Federal Reserve recorded, what the FDIC reported, what the Bureau of Labor Statistics confirmed, what Dalbar measured across decades of investor behavior. These aren't predictions. They're patterns from the last time the signals look like this. None of this is financial advice. What it is a map of what worked for the people who came through the last crisis better than they went in. History doesn't repeat exactly, but it rides closely enough that the people who studied it in 2006 made different decisions than the people who didn't. Do your own research. Look at where you are right now across each of these 7 moves. Talk to someone qualified to help you apply them to your specific situation. The goal of this video isn't to tell you what to do. It's to show you what other people did when the signals looked like this and what it cost the ones who waited. The window was open in 2006. Most people didn't use it. It's open right now. What you do with that is your decision.